David, thank you very much for joining us today. You are an economist by training and you worked on Wall Street for many years. And I'm curious why you left the security of the corporate world to go it on your own.
It's just literally trying to hope I can reach a broader set of people, to perform a little bit of public service, if you like, because I do think that the world, like to the extent that I think, the polarization of the world of the last few years, which I think is the biggest story of the last, 20 years that I can remember. I think that there's so much misunderstanding about what it means. And then I want to do my little part, the little bit that I can to help maybe stop the world from going towards a war. And that's what I'm trying to do.
And you know what's amazing about a lot of what you said is when you and I grew up in this industry, everybody got their news and information from CNBC or Bloomberg. And now, because of this platform we're on now, YouTube, it's open to anybody and everybody, right? And YouTube's the second largest search engine in the world with over 2 billion subscribers. And it's just amazing how it's opened up to this whole new universe of investors.
I agree. I mean, exactly. I think if you think about me, I was a regular guest on CNBC and Bloomberg TV for many years. I still am actually on Bloomberg at least. But the truth is that, you realize that CNBC and Bloomberg, they're just part of the Wall Street mafia, and there's no doubt a mafia. And that mafia is completely inaccessible for the average guy at home, basically. And, and I was thinking, pretty amazing. Like once you get into Wall Street, your income, earning power goes to a completely different level. Like, you think, yet, I don't have to tell you, 85% of actively managed equity mutual funds underperform their benchmark year in and year out. Okay. And I'm not even sure to what extent people work on Wall Street, those who manage to get in, okay, are necessarily the smartest, the most qualified, and so on and so forth. And I think CNBC and Bloomberg just reinforce that because in some sense, what it comes down to is that, Wall Street banks produce their research, which then get disseminated to the rest of Wall Street by CNBC, Bloomberg, all these talking heads go on these television, basically stealing their own juice. And the question is, to me, is always about accountability. Because at the end of the day, these people go on CNBC talk about, I like this, I like that, I'm investing in this and that. Like, you have no idea, if they actually, let's just say, what's their investment track record of the ideas, the recommendation they're talking about out there in the show? Are they right in the end? There is no way for, I'm got a PhD in economics. I worked on Wall Street for 30 years. I think I can tell, okay? But most guys at home can't tell. And the great thing about YouTube is that it sort of forces you to make your stuff much more accessible in the sense that, I try to avoid using technical jargons when I'm on YouTube to the extent that I want basically more people to understand what I'm talking about. And I want basically people, and then the great thing about YouTube is that people can look back what I said a week ago, a month ago, a year ago, and so on and so forth. Well, you are completely right or you are completely wrong. And I love that basically that level of transparency because transparency is what creates accountability. And I think there's just not enough of it on Wall Street, unfortunately.
Very good point. So let's move on. I want to get your views on the U.S. economy. It is the largest economy in the world, representing 25% of the global economy. So what happens in the U.S. impacts all of us in the world, especially if you live in Canada like I do. But when you look at the economy, from my perspective, things look great. The U.S. economy is growing at 3 to 4% annualized. The jobless rate is below 4%, and it has been for 25 consecutive quarters now. And the last time we saw that was 1969. The stock market continues to make new highs every day. What about from your perspective? Do you think things are as solid as they appear to be?
I think, it's solid enough, let's put it that way, right? I think, certainly, and I think, when we're talking about economic performance, I think in the end, we can only talk about economic performance in relative terms. There's no doubt the US is doing very well compared to 99% of other economies, right? A good example, of course, is Canada, right? So while Canada, they're also English speaking, they share the same border with the US, they're also far away from the Russian-Ukraine war, and so on and so forth. But Canada is clearly not doing as well as the US. right? I mean, and then the most interesting and the most stark, I think, difference between the US and Canada in terms of their economies is the fact that productivity growth in the US last year looked like probably was closer to 2%, okay? Whereas Canada was close to zero, basically, you know? And it tells you a lot about, you know, what makes American economy great, if we want to use that word, great. It's simply much more dynamic. You know, it's actually very interesting because if you look at actually, especially post-pandemic, like US labor productivity has literally gone up more than for any other major economy, with the exception of Israel, actually, until the invasion came about. But what really happened was the fact that companies very quickly adapted to the pandemic. They started to invest aggressively to allow people to work remote from home. And then new businesses sprang up overnight and then adopted new technology and so on and so forth. So I think from that point of view, like, you know, there's no doubt, like we can sit here and talk about, yeah, it's easy money and then basically massive fiscal stimulus, and all that is correct too. I mean, the US budget deficit clearly the 2%, at $2 trillion, you know, basically, you know, it's simply not sustainable. And then financial conditions are too easy. There are a lot of serious problems with the US economy, don't get me wrong. But there is no doubt, time and again, what makes the US economy great and then makes its problems more forgivable is the dynamic nature of the US economy, which allows us to grow. And then I think, you know, if you can grow 3% a year, a lot of problems become, you know, smaller very quickly. Whereas if you're growing at 1% a year, and even if you look on the balance sheet, look okay, that's not great. Okay. So I think from that point of view, like I think, you know, the US economy at the moment, at least, I think, you know, the most impressive aspect is basically productivity growth, and which leads the world, actually, at least among the developed countries. And this is even before AI kicks into even first gear, let alone second, third, and fourth gear, for that matter. And I think from that point of view, to the extent 90% of AI companies today are American companies, and American companies are the first ones to adopt AI as a productivity enhancing technology, this is going to be a massive, basically, a boost for the US economy for many years to come. So yeah, if you want to look at this from a glass half full perspective, I certainly think that right now there is a lot going for the US economy that is surprising many people, and including myself.
And this move that we're seeing in the stock market, it's all predicated on the Fed cutting rates. And when we entered 2024, the expectation was for 6 cuts, okay? And then we started seeing some stronger than expected data. And now that expectation is down to 3 cuts. Well, what's your view? Do you think we're going to see 3 interest rate cuts this year? And if so, when will it start?
By the way, I just want to say this, like, you know, again, you can go back to what I was saying in my YouTube channel at the start of the year. I said, when the market was pricing 7 cuts, I thought that was insane. I said, the max they're going to do is 3. So I think from that, I mean, I actually make quite a bit of money for myself and my clients, actually shorting bonds in January. Now, of course, you know, and now the market is pricing in 3. Personally, I think, again, I don't want to get into like, okay, fine, are they going to, in the end, I don't want you to judge me on, like, you know, on December 31st, 2024, you're going to call me up and say, wow, you said 3, they did more or less, whatever it is. Right now, what I'm telling you is that I feel confident is that we're probably going to, the market is going to go from pricing 3 right now to pricing 1 cut for 2024. Okay. I think, you know, the economy, I mean, the non-farm payroll number last week couldn't be any stronger. Okay. And we saw, you know, basically strong hiring, not only from the establishment survey, but also from the household survey. We saw healthy, basically, expansion of the labor force. We saw nice, healthy growth in wage growth, you know. And I think from that point of view, like, this is consistent, by the way, you know, the non-farm payroll numbers last week, okay, is consistent with GDP growth greater than 3% for the first quarter. Okay, we're talking in real terms, which means is the economy is growing above trend, because trend is probably around 2. So the economy is growing above trend. And then so far in the last 6 months, I mean, this is the whole thing about this inflation. The truth is that when you look at on a month-on-month basis, Inflation was going down in the first half of last year, but it stopped going down already in the second half. Okay. The only reason why on a year-on-year comparison it went down, it was because due to the so-called base effect. That base effect is out. Okay. So from that point, what we've been saying is that actually the acceleration of inflation. I think if core services inflation, which will be released this Wednesday, were to come in anywhere close, let's say 0.4%, which is my forecast, which is the average of the last 6 months, I think the Fed runs the risk of basically, falling behind the curve. And I think at that point, okay, moving from 3 cuts to 2 cuts guidance, it would do nothing in terms of financial conditions. At that point, they will have no choice but to go to 1 cut. And I think then the stock market might pay some attention, because there is no doubt that the stock market is the reason why, inflation doesn't want to go down, because the stock market is a proxy of financial conditions, okay, for the economy. At the end of the day, modern monetary policy is not set by interest rates, but set by financial conditions. What the Fed has done in the last, it's actually very ironic. Despite the fact that the Fed has not yet even cut once, financial conditions in the last 6 months have loosened so much that they're now back at the low of basically the start of 2022. That is before the Fed even started hiking rates. Okay. And that's largely thanks to, credit spread basic tightening with the stock market going up, because stock market going up, it just basically, makes everybody wealthier, more willing to go out and spend. It reduces the cost of capital and so on and so forth. Companies more willing to invest and so on and so forth. My point is that I don't see how the Fed is going to be able to bring inflation down to 2% without driving down the stock market. And I've been saying this for a while. And then I think that is still ahead of us.
Okay, so let's do a deeper dive on inflation. And 2023 was known as the year of the strikes. 500,000 workers staged over 400 strikes. That's the highest we've seen in 23 years. And the workers are going on strike because they want higher wages, of course, because they want their wages to be kept up to the rate of inflation. And these strikes have resulted in higher wages and therefore more inflation. And do you think that there's a risk that the economy is stronger than we are led to believe? And do you think that these higher wages are going to trickle through and lead to higher inflation? And therefore there's a risk that the Fed doesn't cut rates at all this year and maybe even increases as we go into 2025?
I think anything is possible, but I think, again, let's think about this in relative terms. We said U.S. labor productivity growth remains the strongest of all the major economies. And guess what? And wages are growing, more or less in line with the OECD average, which is around 4 and 5%. Okay. As a result, labor cost, okay, is growing at around 2.5%, which is among one of the lowest, okay, among OECD countries, which itself makes it very interesting. Because at the end of the day, you know what? If your wage, like in Canada, for example, wages are growing up very briskly, and then but productivity growth is not going anywhere. As a result, unit labor cost is going up much faster, right? Because unit labor cost is what ultimately determine the cost of making stuff, determines basically the profit margin of a company and so on and so forth. Okay. The fact that labor productivity is growing at 2%, that just basically means that a very big part of the wage growth that American workers are seeing actually is reflected in producing more, okay? Which means that inflation, this is the reason why actually the Fed hasn't been that concerned about basically inflation. That's why they were so convinced that we've seen the peak inflation, that disinflation is kicking in. But what I'm telling you, and then there is some truth to that. There's no doubt, again, relative to other countries, there's no doubt this is very much the case. But the inflation picture is more complicated than just basically unit labor costs, because, like in the US, for example, healthcare, or between healthcare and basically housing, that's like 50% of core, inflation. And then those things don't really have that much to do with basically, labor cost, okay? And those things are definitely pushing up core inflation right now and creating a lot of problems for the Fed. So I think, right now, am I saying that the economy, I think right now, like economy growing at 3%, I think it's probably as strong as it's going to get because, any faster growth means overheating when unemployment was at 3.8%. But my gut tells me that, the Fed probably at this point, okay, is behind the curve, which means that they'll have to tighten financial conditions, which means and then, clearly, if the market went from pricing 7 cuts to 3 cuts and the stock market is actually up 10%, it would mean that if they would go from 2 cuts to 3 cuts to 2 cuts, it's not going to have any basically effect on the stock market, which means that they'll probably have to go to 1 cut. And that's what I think right now, for the time being, I think that's where they're going to go. And I think from that point of view, again, I think, if the inflation numbers even if the inflation this week were to basically come in line with the average of the last 6 months, I think they're going to have no choice but to basically, essentially concede that inflation is stickier, the economy is, stronger than they thought. They'll have to do more. Okay. When are they going to be hiking rates this year? Let's hope not. It's not impossible. After all, we're in an election year. Okay. If they were to basically hike rates, certainly there would be a lot of people in the US are going to basically accuse the Fed of being partisan, voting for hiking rates in order to basically to help Trump get elected. So I think from that point of view, my research shows very clearly in the last 50 years, in presidential election year, the Fed has generally liked to sit on its hands. This is why if you look at changes in interest rates in the 4th year of any presidential cycle, it's much less than in the 1st, 2nd, and 3rd year. And I think the Fed just wants to stay away from the limelight. I'm sure they don't like being in the limelight so much, okay, because they don't want to be seen as casting the most decisive vote in this most contentious election in 100 years. But I think, unfortunately, and this is also the reason why if they're going to do something, they'll have to do something sooner rather than later. Okay, because they don't want to basically wait. If they really come to the conclusion that I have already, that the Fed is behind the curve and that financial conditions are too easy and that inflation is not going back down to 2% at this current trajectory anytime soon, they might have to basically tighten financial conditions next month. They can't afford to do nothing and take a wait and see attitude, because then what happens August, September, 2 months before the election, they're having to basically all of a sudden pull back and the stock market drop 20%. That is the last thing the Fed wants to be held responsible for, which is the outcome of the US election.
Okay, so I want to clarify one point. When you said next month they might tighten monetary policy, what do you mean exactly?
Tightening right now, we're just talking about verbal intervention. Right. I mean, because I think that they interest rates, right? Bonds and interest rates trade on expectations, right? So from that point of view, if tomorrow, right now, the market is pricing whatever 3 cuts, okay, over the rest of 2024, okay, and if all of a sudden, Jerome Powell comes out tomorrow and tells you that, well, listen, we're only going to cut once this year. This will mean that, let's just say, a longer, basically term bond, like a 10-year treasury, basically bond, the yield right now is at 4.4%. I could easily see it going to 4.6 or 4.7%. Okay. Obviously, because the stock market reacts to long-term interest rates as opposed to short-term interest rates. But ultimately, long-term interest rates are just basically a bunch of, think of it as packets of, expectation of future short-term interest rates. So with that short-term interest rate trajectory changes, it basically moves long-term bond yields. And when long-term bond yields go up and down, that has an immediate effect on all the markets, whether it's a stock market, credit market, or any other market for that matter. So yeah, the Fed can tighten financial conditions by driving up. The Fed can drive up long-term bond yields without actually raising interest rates right now. All they have to do is just pivot away from their previous guidance, which is for 3 cuts, interest rates cuts this year. If they said, we're only going to cut 1 time this year, the long-term interest rate is going to go up.
A large component of the consumer price index is energy. And the Biden administration has been very good at keeping the oil price low, and this has helped contain inflation. And the U.S. government is clearly using oil as a political weapon or as an economic weapon. They released the U.S. strategic oil reserves. The administration also has turned a blind eye to Iranian oil exports. And then I believe it was in Q4 of 23 where the Biden government also relaxed sanctions on Venezuela, allowing them to sell oil into the open market. And all of these elements have helped keep the oil price low. But we've recently seen a move in the oil price from the mid 70s to the mid 80s. Do you think there's a threat that oil can continue to go higher here and therefore lead to higher inflation, especially as we head into the summer months when it tends to result in higher oil prices?
Sure. So I think there are a few elements here, I think, which is very important, right? I think, listen, I mean, last year, honestly, I thought oil prices should have gone a lot higher in 2023. And there were two reasons why oil price actually went down in 2023. One was, as you said, the U.S. stopped enforcing the existing sanctions on Iran's oil export. I mean, that was a huge deal. Because Biden, by not enforcing the sanctions on Iran's oil exports went up by about 1 million barrels per day. That's worth at least 10, if not $12 in oil price per barrel, right? I mean, that was a huge deal. Okay, that was nobody basically factored that in January 2023. At least I did. Okay. The other major development, of course, was the massive increase in U.S. oil production. That kicked in basically, in the third quarter last year. I mean, U.S. oil production went up by 1 million barrels per day. Between sometime in the third quarter last year, which was again. Like I'm fairly sure, like even basically Jeff Curry at Goldman Sachs, the legendary, basically oil specialist, like did not see that coming. Nobody did. Okay. And I personally, I mean, until this very day, I'm trying to figure out like what happened. Like, that was like a sort of like a 10 standard deviation event, right? I mean, it was sort of something completely unexpected. And I think in the end, I don't know if it's true or not. If you recall, like you're an oil, you're a commodity guy. Exxon and Chevron both basically announced huge acquisition, okay, in July and August, right? Exxon for Pioneer and then Chevron for Hess, And so basically the oil industry clearly was getting ready for a period of consolidation, which usually is associated with lower production. But they also understood that for these acquisitions to go through, they need a blessing from the President of the United States, okay? And they also realized the President of the United States needed low oil price more than anything else if he has a chance of being reelected, okay? And I think that's what actually happened. They announced the deal, and perhaps as a message to the president, okay, listen, we are going to, like, if you approve this deal, we're going to drill and drill and drill until oil price collapse to help you get it. I think that was the story, actually. Because there is no way, because I mean, clearly that extra 1 million barrels per day the U.S. is still pumping right now. It's obviously spare capacity that magically just basically like materialized. So you're talking about 2 million barrels per day last year. That was the reason why oil price did not go much higher last year. And then both of which have nothing to do with economics, having to do with politics and geopolitics. Now, this year, it's a very different story. Because first of all, my view is very simple. Like OPEC plus is a much more powerful cartel than OPEC used to be. Okay. Especially given the fact that Mohammed bin Salman, the crown prince of Saudi Arabia, and Vladimir Putin are like literally like, two best friends. I mean, okay, they're like real buddies. I mean, they love each other. I mean, actually, and I can completely understand why, and so on and so forth. There's a personal chemistry. And also, of course, OPEC, most of these Gulf countries, they'll do anything to help to make sure that Putin wins the war in Ukraine. And I don't blame them. Okay. So from that point of view, I think the cartel has much greater price, basically production discipline than ever did before. and it's very credible and led by Russia and basically Saudi Arabia. So they're like everybody else is basically followed their lead. And I think in that sense, this is so from that point of view, unless the US can pump some more, you know what? The fact that OPEC has managed to, enforce its production cuts, I think that makes the whole situation a very different. I mean, the day that, basically the president of the United States can pick up the phone and call up, the Saudi, king and say, you know what, open the tap. Those days are completely over. Like Mohammed bin Salman wouldn't even take, Joe Biden's phone call these days. I can tell you that much. Okay. It's a very different relationship he had with Trump. But Trump, he loved Trump. He owes his career to actually Trump. But like Biden, he wouldn't even answer this call. So from that point of view, this is a very different story. And then there's Iran, right? Because the issue is this. This is where the real issue is, right? So basically, Biden decides to go screw Putin, right? With the oil sanction, okay? And he decided to offset the loss in Russian oil by basically getting Iran to produce more. Now, you think that Iran is not clever? They're sitting there right now, the Ayatollah, okay, sitting there right now thinking, you know what? I've really got Biden's right here because I'm producing, the only reason why oil price is not higher is because I'm producing an extra million barrels per day, okay, for the world economy, okay? If I decide to shut that off, okay, Biden can just basically kiss his second term goodbye, okay? And what does that mean? Iran was absolutely convinced since the start of the, Hamas, basically attack on Israel on October 7th, that the US would not dare to even basically to basically hurt the hair on the heads of Iranian proxies in the Middle East. Because Iran is absolutely convinced that US will do anything to avoid basically a regional war, which will certainly basically push oil prices a lot higher because for one thing, a regional war, means that most likely the Iranian oil export, that extra 1 million barrels per day for the world, will basically, will go away because there are plenty of Republicans who are calling for basically the reimposition of the sanctions. And this is why Iran is absolutely convinced all it needs to do is to basically get the Houthis to keep attacking basically ships going through the Red Sea, put pressure on the US, to put pressure on Israel, to flush Israel down the toilet. So this is why the oil politics become so powerful, because in this case, it's a case in point that Iran, that Joe Biden, in the US in many ways, by deciding to use Iranian oil to make up for the Russian shortfall, has actually created a hugely tricky situation for US foreign policy, is now being held hostage by Iran, which is now flushing its basically closest ally in the region down the toilet in order to get Joe Biden reelected in 2024. And then of course, I live in Israel, and I can tell you that in Israel, of course, we're now at this point that 90% of Israelis are willing to say, screw the Americans. This is an existential war for us. We have to. That's why they assassinated these two Iranian generals. Because what it is, this Gaza war, is a proxy war between Israel and Iran. Have no illusion. This is not about the Palestinian question. This is about Israel versus Iran, okay? Because Israel is fighting Iranian proxies. Hezbollah in Lebanon, Iranian-backed militias in Iraq and Syria who have been shelling Israel, okay? Basically Hamas in Gaza and the Houthis in Yemen. Israel surrounded by Iranian proxies who are now putting a big squeeze, and the Iranians are banking that the US will basically, hold Israel back to stop Israel from fighting back in order to avoid a regional war that could cost basically Biden his reelection. And this is where it gets very interesting. But Israel at this point, I think, doesn't have that much room to maneuver because, this is not about Bibi Netanyahu, whether what kind of basically president, prime minister he is. This is an existential war. They need to take care of basically Hamas. So I think from that point, I think the market is only starting to wake up to that reality, which is that U.S. pressure on Israel probably only has a limited impact up to a point. That at the end of it, this is not the 51st state of the United States. I mean, Israel, obviously, like US is the most important ally for Israel, but this is not a war that Israel can afford to basically lose. And I think from that point of view, that's what the recent volatility in oil price has been about. It's about like, oh, wow, Israel basically just killed these two Iranian generals. So what is Iran going to do to retaliate? I actually think I'm not that worried, actually. I think the market last week lost. I mean, I think neither the oil market or the stock market or most political analysts, they don't understand Iran. They don't understand the policy reaction function of Iran. Okay. The policy action of Iran since actually the Mohammed basically Soleimani, who was assassinated by the US, by Trump actually back in 2020. But that policy has continued to this very day, is that Iran's big focus is to basically preserve and protect its nuclear program at all cost. Okay. So if they were to attack Israel, okay, from Iran, for example, like that would just give Israel a perfect excuse to go in there with F-35, F-16 and drop some basically bunker buster bombs on the, nuclear basically facilities and set them back. They don't want that. This is why Iranian policy has always been using these proxies, okay, to attack. Because when you use proxies, you can always say, what, it's nothing to do with me. Like, I don't know these guys. Who are these guys? Okay. They didn't get the order from me. I have no idea. It's nothing to do with us. Okay. So I think from that point of view, I don't think Iran is going to attack immediately, retaliate immediately. And I definitely don't think there will be any strikes attack on Israel directly from Iran. It will be continuation of the proxies, which will probably intensify as Israel readies herself to go into Rafah. And that's where it gets interesting. But my view is that that's probably not for another few more weeks either. Because, there are a million, civilians sitting in Rafah right now. Israel has committed itself to basically evacuate these million people before it goes into Rafah. Now, just let me tell you this. The logistics of evacuating a million people are very, very complicated. It will take weeks, okay, once they decide to do it, and they haven't even started doing it yet. So in my view, this is not a tradable story in the sense that it's not happening tomorrow. It's probably going to be like a story in May, if it happens in May, okay? Which means the spike in VIX and oil and gold last week on the back of, CIA says Iran is going to retaliate right away. That just shows that, these guys are amateurs. And I think, it's probably, my view is that it's probably not going to happen. Of course, nothing is, basically definitive, but my view is that the risk, I am definitely worried about geopolitical risk, but it's not right now. It's probably more like, the beginning of May. So like right now, like I can imagine actually in the next couple of weeks, like VIX coming down, gold coming down, and maybe even oil coming down over the next few trading days at least.
So there's a lot to unpack there, but I want to try to summarize a few of the points that you made. And once again, from my perspective, the U.S. wants lower oil prices because Biden wants to win the next election. He wants to contain inflation. He wants to keep the economy strong. But Russia and the Saudis, they want higher oil prices because, of course, they want to make more money and maybe they want to try to screw over the Biden administration. But you're saying the higher oil prices that we've seen here in the last few weeks not necessarily has to do with that, but more has to do with the threat of a regional expansion of this war.
Yeah, I think there's that. And there's also what's happening in Ukraine. Because as you probably know, like, over the last, it's been 2 months now, actually, Ukraine has been launching drone attacks on Russian energy facilities, refineries and, and other. In fact, actually, I think as we speak, about 10-15% of Russian refinery capacity is still basically offline. So actually, it's interesting because now you say, well, why are the Ukrainians attacking Russian refinery capacity? And this, I think this is a similar type of situation. Zelenskyy is trying to send a message to Biden saying, if you don't start sending some money over here very soon, like we're going to do our part to drive up oil price to make you unelectable. We're in the same boat. Mr. President. I actually think that is a very big part of it, because actually what happened was, of course, like, so like that was what was going on actually in the beginning of, up to the second week of March. That was actually the big story, which was like, oil prices going up because like, Russian refineries were down. And then people worry about like, who's going to make up for the shortfall of Russian basically product, basically supplying the market, actually. And it was interesting because once oil got up to $85 a barrel, the Financial Times ran a big story citing some senior officials in Kiev saying that they've been getting this message from the State Department, okay, in the previous few days, saying that the America strongly discouraged them from continuing with basically the campaign to disrupt Russian oil supply because Biden does not want high oil price. It was very, very interesting because you can see this almost like in real time. This is why, like, those of you watching this from home, like, again, the great thing about international politics is that there are always a lot of stuff, telltale signs. If you know what to look and where to look, you'll find, the stories that help you tell the story to actually really understand what is really going on behind the scene. And then, of course, a week later, like Zelenskyy basically made a speech saying that, wow, listen, but we have no choice but to attack the Russian refineries because this is the only way they might listen to us. Again, he was not speaking to Putin. He was speaking to the Americans saying, you know what, again, get your money over here and then we can talk. Otherwise, like, you don't tell us what to do. Okay. So I think, there's no doubt I think oil going from, let's say, $80, let's say $78 to what we are now, just shy of 90 on Brent. I think a lot of it has to do with geopolitical risk involving both the Russia-Ukraine war and the Israel-Iran conflict.
So let's assume that we have an escalation of what's happening in the Middle East, okay, and it expands to other countries. And I wanted to get your thoughts on maybe another oil shock like we saw in the 1970s. And in 1973, the U.S. suffered a major oil price shock due to an oil embargo because of U.S. support for Israel during the Yom Kippur War. And the oil price went from $3 a barrel to $11 a barrel within a year, an increase of 266%. And that's the equivalent of oil going from $85 a barrel to $220 a barrel now. Do you see the threat of this happening? And I'm wondering if it does, if it could happen, what like the reverberations to the global economy would be immense.
I think under Biden, I would say that the risk is higher than if we were to get Trump, for example, because I know what Trump will do. I think Trump is, I have no doubt, like, I think Trump is right. Like, I think he can stop the war, like in Ukraine immediately. Okay. For the same reason, I think he'd be able to stop what's going on in the Middle East immediately. Because for one thing, Trump would just take a hugely tough line on Iran. And Iran will back down, by the way. I guarantee you. Okay. Now, the thing with Biden is that we're now in a situation where, again, right, we're talking about, Iran and its proxies, they don't take the US threat very seriously. You saw what happened, right? Like even with the Houthis, the Americans and the British, basically carry out strike on Houthi targets in Yemen. But guess what? Like they didn't even basically like damage 10% of the infrastructure. And I, by the way, made a video about this, like a day after the US basically struck basically the Houthis. I said, this is not even going to do anything. And the argument I gave was that the Houthis spent 9 years in a civil war, fighting against the most advanced American weapons used against them by the Saudi-led coalition, okay? And then not only survived that, they won. And the reason is because these guys fight a very low-tech war. Like, unless you're willing to send troops in to get them, these guys are hiding underground, just like, Hamas is in its tunnels. Like, you can't get them. I still remember when the Saudis actually went into Yemen and bombed them until the kingdom came. Of course, then they were immediately essentially accused of genocide. Iran knows how to play this game very well. My point here is that this is why, like, in a game theory where, where a crisis is likely to happen is when people underestimate each other. When you think, when you're trying to overplay your hand, that's when things get out of control. So, for example, right? I mean, what is very clear is that the Americans have been trying to broker the ceasefire agreement between Israel and Hamas. It's very clear that Hamas is not interested in a ceasefire. Okay. And the reason is because they can see that Iran's winning, that, they can see that, on top of that, for them, survival is victory. They don't want a temporary ceasefire. They certainly would not release any hostages, which is their, basically their insurance, okay, for a temporary ceasefire that will allow Israel to go in there and eventually destroy them. They don't even like the idea of a temporary ceasefire because the Americans want to use those 6 weeks of ceasefire to basically airlift in the Palestinian Authority in the West Bank into Gaza to take over. So Hamas wants to survive, and that's it. So they're not going to agree to any temporary ceasefire. That's why it was interesting, because Biden yesterday spoke to both the Qataris and Egyptians, trying to pressure them to pressure Hamas to basically agree to the ceasefire. So far, there's just no movement. So that is a sign of overplaying your hand. The Hamas thinks that Iran is winning. They're going to basically play really tough. But that's going to leave Biden with a very little choice but to give Israel the green light to go into Rafah, to destroy basically Hamas. You see what I'm saying? So this is the kind of game that's being played. But the way it's being played, because the U.S. lost so much deterrence under basically Biden, that people are now second guessing what the U.S. is going to do and not do, this and that. Maybe they're too weak. I mean, Putin probably wouldn't have invaded Ukraine the way he did if Biden had not pulled out of Afghanistan in such a haste as he did, that looks so ugly. Okay, so I think from that point of view, this is where, because people see the U.S. hegemony, the Pax Americana being on very shaky ground, American enemies are going to test you. And it's that testing, and all of a sudden, America is going to go out of control. That's when oil price go all the way up. Because now you're in a regional war. We can tell scenario, of course. I mean, if there's any attack on Iran, let's put it that way, okay? If Iran gets directly involved in a regional war, Iran will definitely target the Saudi oil fields, okay, in their retaliation. They certainly got the missiles, they got the drones, they can literally take out, the oil production in Saudi Arabia, UAE, all the neighboring countries with great ease, actually. Okay, I mean, remember, Iran actually, we're now in the age of drones, and Iran today is one of the leaders of drone technology. But the Russians are using Iranian drones. Okay, so I think from that point of view, this is why, they can't invade the U.S., but they can certainly, disrupt oil production in the Middle East hugely. And that will, again, this is not my central scenario, because I think for us to get down that path, I mean, literally, something really bad will have to happen. Somebody will have to make a huge mistake to not, to sort of to allow us to get to that point. But what I'm saying is that to get oil to $200 a barrel, not only, if the Iranian oil production goes away, that will get you, let's say, to $100. That's not the end of the world. To get to 200, you will need, Iranian strikes on basically Saudi and Kuwaiti oil fields.